For so many years, empires were created using armies, ships, and flags planted on foreign soil. But in today's world, power is exercised in a more subtle manner, through markets rather than battlefields. At the heart of this new power is Wall Street. It began as a small financial district in the city of New York. However, it soon grew into something much bigger. It became the control room for global capital. It makes decisions that spread across the world in seconds. Governments take notice when markets stir. And in many ways, Wall Street became a new kind of empire. Wall Street started as a physical wall erected by Dutch settlers. It was a demarcation boundary, but it was also a symbol of ambition. Merchants assembled there to exchange goods and promises. These promises later turned into stocks and bonds. The New York Stock Exchange was formally organized in 1792. It provided a formal market for investments. Early financiers learned how to combine risk and reward. Capital began to flow more systematically. Faith in markets gradually replaced faith in monarchies. A financial base for a new country was established. The 19th century saw the rise of railroads, steel, and oil. These were huge industries that needed huge capital outlays. Wall Street became the conduit between ideas and capital. Financiers provided money for expansion across the American continent. Financiers created industrial titans such as Rockefeller and Carnegie. Their firms changed the economic landscape. Investment banks financed their growth. Wealth accumulated in a manner unprecedented in history. The power of corporations began to rival that of governments. Finance became the driving force behind industrial power. Banks grew from mere lenders to financial visionaries. They planned mergers and acquisitions. They developed sophisticated securities to lure investors. Money was no longer merely saved. It was made. The Federal Reserve was established in 1913. It connected Wall Street to the national monetary system. Interest rates became instruments of power. Liquidity could either stabilize or destabilize the economy. Financial institutions assumed systemic significance. The very foundation of modern capitalism was laid. The crash of 1929 revealed the folly of speculation. Markets went bust and fortunes vanished overnight. The Great Depression struck with calamitous consequences. The public's faith in finance was lost. Legislation such as the Securities Act were enacted. Glass-Steagall legislation separated commercial and investment banking. Regulation was an attempt to rein in the unruly. However, even in times of turmoil, Wall Street endured. It adjusted to the new realities, and it set the stage for another rise. After World War II, the United States was supreme. The US dollar became the global currency. Wall Street funded the reconstruction of foreign economies. Institutions such as the IMF and World Bank were shaped by US policies. Capital markets were expanded globally. Foreign firms sought investment from Americans. New York became the financial capital of the world. Financial diplomacy replaced colonialism. Economic power shaped global politics. Influence was exercised without conquest. Control of the global currency meant control. Oil and commodities were priced in US dollars. Countries needed access to US financial markets. Sanctions became a tool of statecraft. Access to capital meant reward or punishment for governments. Debt-bound emerging markets were tied to international lenders. Financial policy had a role in geopolitics. The interests of Wall Street were in line with strategic policy. Market responses to political tensions were instantaneous. The power of currencies increased economic might. Investment banks grew rapidly in the latter part of the 20th century. They served as advisors to governments and corporations. Derivatives of complex design were developed. Risk was packaged and sold worldwide. Earnings skyrocketed during boom cycles. The compensation culture underwent a radical shift. Wall Street became synonymous with high stakes. Financial innovation outpaced regulation. Innovation pushed the boundaries of ethics. Power was concentrated in the hands of a few institutions. The 1980s marked the beginning of financial deregulation. Restrictions were eased for the sake of growth. Capital moved freely across borders. Mergers led to the creation of megabanks. Technology accelerated trading. Markets were open 24/7. Globalization increased competition. Risk-taking reached unprecedented levels. Short-term thinking often led to the neglect of long-term stability. The power of Wall Street increased. Computers revolutionized trading floors. Algorithms replaced human gestures on trading floors. High-frequency trading became a reality. Transactions took place in microseconds. Data became the new currency. Information superiority led to profits. Global markets were synchronized. Volatility spread at an unprecedented rate. Innovation created a chasm between insiders and outsiders. Finance entered the digital age. The housing bubble grew at an incredible rate. Mortgage-backed securities hid risk. Banks were heavily leveraged. When defaults increased, panic set in. Lehman Brothers went bankrupt. Credit markets froze worldwide. Governments launched massive bailouts. Public outrage intensified. The too-big-to-fail institution became common. Wall Street survived another crisis. Bailouts with taxpayer dollars helped large banks. Top executives were not held accountable. Market confidence gradually returned. Stock market values surged. Critics claimed that inequality increased. Main Street suffered while Wall Street prospered. Public trust in institutions declined. Dodd-Frank laws were enacted. Accountability remains a topic of discussion. Financial dominance persists. Capital flows worldwide in an instant. Diversification occurs globally. Growing economies depend on foreign capital. Sovereign debt markets grew in size. Exchange rate variability affects daily life. Global Wall Street operations are common. Financial crises are contagious. Globalization makes the system more fragile. Opportunity and risk exist side by side. Global finance integrates economies. Alternative investments became popular. Hedge funds engaged in aggressive investment. Private equity changed whole industries. Leverage maximized gains. Anonymity often shrouded operations. Wealthy individuals sought higher returns. Corporate restructuring became the norm. Short-term gains drove investment decisions. Social responsibility was questioned. Financial dominance extended into corporate governance. Long hours and extreme pressure characterize the culture. Competition fuels ambition and drive. Bonuses represent success. Networking provides access. Elite status attracts the best and brightest. Risk-taking is often rewarded. Failure can be sudden and severe. The media both glorifies and criticizes the industry. Public perception varies between admiration and resentment. Culture defines the identity of the empire. Financial institutions spend lavishly on lobbying. Campaign donations purchase influence. Policy decisions may serve market interests. Frameworks for regulation are negotiated. The revolving door connects government and finance. Experts move between sectors. Regulatory capture is predicted by critics. Collaboration is necessary for stability, according to supporters. Politics and markets are deeply connected. Influence is not limited to the trading floor. Wealth is created on a massive scale by financial markets. However, asset ownership is not evenly distributed. The stock market is beneficial to investors. Wages do not keep pace with returns on capital. Housing affordability worsens in large cities. Wealth disparities emerge between generations. Social unrest increases. Taxation policies become more contentious. Wall Street represents inequality. Social structures are determined by economic might. Bears in the market present buying opportunities. Troubled assets are sought after by strategic investors. Liquidity suppliers have more power. Government actions ensure stability in the system. Strong companies thrive during times of turmoil. Volatility fosters innovation. Lessons are learned but often forgotten. Cycles of boom and bust recur over decades. Survival cements dominance. Crisis is now a beat in the empire's rhythm. Online trading platforms leveled the playing field. Individual investors participated in the market in waves. Social media platforms affected stock market performance. Meme stocks subverted traditional power structures. Volatility increased unpredictably. Information availability increased. Entry costs decreased. Financial knowledge was now essential. The balance of power shifted very slightly. However, institutional money remains in the lead. Bitcoin undermined conventional currency structures. Blockchain enabled transparency. Decentralized finance promised autonomy. Speculation fueled volatility. Regulators took a cautious approach. Wall Street companies started providing crypto-based products. Mainstream adoption added legitimacy. Discussion about future governance escalated. Innovation upended conventional norms. The empire adjusted as always. Artificial intelligence is revolutionizing analysis. Climate finance is redefining investment strategies. Geopolitical conflicts are testing global frameworks. Digital currencies could redefine monetary policies. Emerging economies are demanding more representation. Regulatory frameworks are still developing. Public attention is high. Technology is driving change. Power structures could change, but finance will endure. Wall Street is at another crossroads. Financial empires in the past were based on borders and soldiers. This one is based on balance sheets and algorithms. It is an invisible presence, but its impact is strong. From individual investors to nation-states, everyone is linked. The growth of Wall Street is a reflection of the changing nature of power. It may be loved or hated, but its impact is clear. It is not a question of whether it is powerful. It is a question of what will be done with that power next.